How's it going, friends and family? My name is Amos, and I want to ask you a quick question. Have you heard of that investing book titled The Little Book That Beats the Market by Joel Greenblatt? And I ask you that question because in his book, he has a so-called magic formula to find compounders in the market that will outperform other stocks. In today's video, we're going to be putting that theory and that formula to the test. In this entire video format, it's going to be a tutorial where we will evaluate the companies together while holding hands. Not in a romantic way, but that way we can see whether or not the formula works. So if that sounds good with you, let's go ahead and get into it. What exactly is Joel Greenblatt's magic formula and why does it matter? So the bottom line up front is that it's a stock screening equation to find potential good businesses that have the cheap prices and a cheap valuation through two metrics. Number one is going to be the return on invested capital, otherwise known as the ROIC. As you can see on your screen, there's a definition, but basically it's how efficient a company is at generating profits from the capital that it invests into the operations. How efficiently they're using capital. And the capital is made up from two things. Number one, the equity of the shares outstanding, and number two, the loans on the books. And the second metric that he likes is the earnings yield. You basically take the earnings before interest and taxes and divide it by the enterprise value. And I think Joel's magic formula into two metrics, it's a good starting point in order to filter out the noise and the ugly companies, but I added some modifications to the magic formula in order to optimize it and make it a little better for value investors, dividend growth investors, XYZ. And between you and me, I'm not trying to throw shade at Joel Greenblatt, but I think the better investing book is the slide deck that I have posted on my Patreon, because it's essentially a 400-page investing book condensed into 40 slides with lessons and examples, and it gets right to the point with easy to understand examples of what and how to invest. It's up on the Patreon. Check it out if you want to. But having said that, what are the additional filters that I am adding to improve the magic formula? Well, number one, we're going to add the market capitalization. And the reason being is that we want to filter in stable companies. As a general rule of nipple, the bigger the market cap for a company, the less volatile they tend to be. And in our case, we're looking at companies that have a market cap of at least above $900 million. I really don't care to look at companies that have a market cap of like 50 million or 200 million. It's just way too volatile and it swings up and down in a very aggressive manner in either direction. So 900 million and above, yes, there will be some small cap players, but for the most part, I'm hoping most of it will be big dogs. And then the second thing that I added, I deleted his earnings yield, and instead I substituted it with a low forward PE ratio, otherwise known as the trading multiple. And in our case, companies that have a trading multiple less than 20. And the PE ratio it's basically a valuation based on the company's current stock price divided by their future bottom line per share, or the profits per share, also known as the earnings per share. It's basically a proxy to see how cheap a stock is. As a general rule, like if it's trading at a multiple of like 9, their PE ratio is a 9, it's cheap on paper. Like if I pull up Palantir and I show you their PE ratio, it's about a 500 or a 600, which means on paper, Palantir is not cheap. They're very expensive. They trade for a premium because there's high expectations baked into them. But as a matter of fact, I do like his return on invested capital metric, so I'm gonna leave that in there, but I'm gonna make the standard really high. Instead of considering companies that have an ROIC of like 7% or 8%, we're only going to be considering the ones that are 15% and above. Now, as a reminder, an ROIC of at least 5% is good. 10%, and we're talking, that's the golden standard. To be above 15%, dude, that company is super duper efficient. And then of course, I'm adding the free cash flow metric, and what I want to see is that they're positive. That way I know that they're a cash generating machine or not. And I put above 0% because then it'll filter out any company whose free cash flow has declined year over year. And Mr. Joel likes to filter out the utilities and the financials, but I fundamentally disagree with that strategy because Personally, I really like my water and electric utility stocks. I think they're dividend compounders with cheese. Yes, they have high CapEx, but dude, they're basically a proxy for a bond with the upside of share price appreciation. So for me, it makes sense because you can get like a 4.5% dividend yield, plus your portfolio valuation can grow. Not at the highest rate like NVIDIA or AMD, but it'll grow alongside with the dividend. So if that sounds good with you, those are the filters that we are applying. So now let's see what we are working with. And I guess another filter that I added that I didn't mention is the country. That company has to be based in the US, because I know the face might say otherwise. I'm an American, and even though I'm ignorant and stupid, I understand how the economy and businesses and enterprises operate in the US. I don't really understand Venezuela. I don't really understand Zimbabwe or even Turkey. So hopefully that's okay with you. So after applying those filters, we're left with about 51 stocks, and right now they're categorized from highest to lowest by their market cap. So the first company that we have is AbbVie. The second one is Merck. So there's two pharmaceutical companies that I guess we should be investigating, but we can also be looking at these companies through their forward PE ratio. So the highest valued one is National Beverage Corporation. I think that's the parent company of LaCroix, the sparkling water company. We can click it again, and then it shows us the lowest ones. I'm obviously going to be skipping these ones right here because they don't have a future forecasted earnings per share. So Herbalife, Slide Insurance. We have Cal-Maine. Dude, Cal-Maine, they're in the business of selling chicken eggs. It's basically a commodity. And if you look at their financials, it's a boom and bust type of cyclicality. And it's just something that is beyond my comfort zone. So I'm going to be skipping Cal-Maine. And we could also be filtering it through the ROIC. We can categorize it by the highest ones to the lowest ones. And even the lowest one at 15.5%, they're very profitable. And that's Yelp, the business enterprise where you can review restaurants, or the person that cut your hair and gave you a bald spot. Dude, one time I went to Korea last year and I got a haircut from someone. He spent an hour and a half taking his time, okay? Because he was an apprentice, he was training, and I got a discounted price to allow a student to cut my hair. An hour and a half. So awesome. Then at the very freaking end, as he was cleaning up the edges and like my neck hair and everything, he accidentally went too high and gave me a bald spot. So about a year and a half ago, I had to cut off all of the hair so that the bald spot wouldn't look so bad. And by the way, if you're wondering why I'm wearing a Tottenham shirt, it's because we just beat Villarreal today in the Champions League 1-0. I think it was an own goal. And I haven't had the chance to watch the highlights, but I will immediately after filming this video. And we could also be filtering it by their free cash flow growth. Like the Rev Group, their free cash flow increased. Dude, that almost sounds like fake news. It increased by 7,800% year over year. Okay, so let's dive in to a company to kind of get a gauge of whether or not it's a fundamentally sound company by utilizing the magic formula with some modifications baked in. Now, personally, I really do not like the pharmaceutical industry as a guy that used to be a strategy leader. But first up to bat is going to be AbbVie, ticker symbol ABBV. So let's take a look at what we're working with. So year to date, they're up by 21.7%, past 1 year, 11.3%. And as of right now, their trading multiple is 102.9. We can round up. I'm going to round up for the rest of this video. Please don't be that smart guy that's like, excuse me, sir, it's actually 102. Please, let's just round up, 103. However, their forward trading multiple is a 16.3. I feel like that's a little more digestible. And the reason why I picked 20 and below is that then we can make the assumption that it's kind of cheaper than the overall market. And when I say that, I'm talking about the S&P 500, also known as the benchmark. I think right now their trading multiple is like a 25, a 26. So to be a 20 or below, they're cheaper than the broad market. Let's jump on over to their financials. First thing I want to take a look at is their revenue. Is it growing? Is it increasing year over year? And friends and family, that seems to be the case. Whereas a lot of the pharmaceuticals are suffering, are hurting, and their margins are being squeezed right out of their left titty, AbbVie so far looks pretty good. Want to look at the efficiency of their operations in terms of their profits per share. This is also known as the bottom line per share. Ooh, this is really bad. So even though their revenue is increasing, their earnings per share is decreasing, which means their margins are being squeezed, which means they're not efficiently running their operations. They're using more money in order to make money. So not good. I mean, if it was stabilized at about, what is this? At about $6 and it's not growing, I'd be like, that's acceptable. But to be going in the wrong trend and to be declining, for me, that's not good. The next thing I want to take into account is their balance sheet. I just want to see what's the cash on the books. Cash and cash equivalents, what's the equivalence portion? It's anything where your money is highly liquid, that you put it into to get like a 3, 4, 5% yield, like a CD, a certificate of deposit, a high yield savings account, a money market fund, whatever. It's basically cash because it's really liquid. And I would argue it's relatively flat, kind of shrinking, because 2015 we're talking about 8.4 billion. And if you fast forward 10 years, now it's 6.4 billion. So they're losing cash slowly. They're bleeding cash to keep the company alive. And the reason why I'm looking at their cash situation is because I want to put it up against their loans and leverage situation. As of right now, friends and family, AbbVie has $70.5 billion of debt on the books. That is a lot. In comparison to their cash and cash equivalents of 6.4 billion, dude, that's a lot. And that's even a lot compared to how much revenue they're generating. $58.3 billion of gross sales, 70 billion of loans on the books. But one ratio that I like to utilize to figure out if the debt is sustainable or not is the debt to EBITDA ratio. And the golden standard is 3 or below, meaning it would take them 3 years or less in order to pay off all of the loans from their operating cash flow. And as I scroll on down and take a look at their debt to EBITDA ratio, yes, it does seem to be sustainable, 2.48. That means it would take them approximately 2.5 years to pay off all of the loans with using their EBITDA if it stays the same and they just generate the same amount of cash and it doesn't grow. So for me, even though the debt looked alarmingly high, from my debt to EBITDA ratio, I know that it's not too crazy and it's not too scary. So far, not too bad, but not good either. Their earnings per share eroding, a red flag. But their gross sales are increasing. Their debt seems to be manageable. And if we jump on over to their free cash flow, I mean, this is fundamentally important because I think AbbVie is a dividend-paying stock. We want to know if the dividend is sustainable. And to know that, the real ones know that the dividends are financed through cash flow coming into the company. And so a good proxy to figure out the health of a dividend is the free cash flow per share. And as of right now, it's $10.29. It's stabilized. Well, I would argue it did increase year over year from $10.06 to what it is now, $10.29, but it did decline from their high of $13.64 in 2022. So let's keep that number in mind, $10.29. Jump on over to their dividend profile, $6.56. So I'm going to tell you right now, on surface level, people might be like, oh, AbbVie's dividend is going to get cut at 300% dividend payout ratio. But it's like, dude, when you compare the dividends per share of $6.56 to their free cash flow per share, which is like $10.20 something cents, it's absolutely sustainable. And to show you what the true payout ratio is, let's look at it. We're going to take $6.56 per share, and we're going to divide it by $10.29, which is the free cash flow per share, and it's going to spit out their true payout ratio, the free cash flow dividend payout ratio. And we're going to times that by 100. So their payout ratio is 63.7%. I would argue very healthy. And to support my argument, their dividend growth rate of 5.8%, do you really think AbbVie would be increasing their dividend if it's a 300% payout ratio that's not affordable? No. The dividend is affordable. That means if we jump on back over to their income statement and we evaluate what's really going on, that means they had like a line item of a tax write-off or a deduction or something happened where they took a loss or a hit, but not in their cash flow, but in an accounting methodology. So that's what we call cooking the books and numbers manipulation. And that's why I prefer to look at the free cash flow per share as a proxy for the EPS and calculating the dividend payout ratio. So I would argue AbbVie, not too bad fundamentally, but after all, it is a pharmaceutical company. So me personally, I wouldn't be adding them to my radar or watch list. If I have permission from you, I would like to skip Merck because that's also a pharmaceutical company. It's probably going to have the exact same or similar numbers to AbbVie, their competitor. Instead, I'm debating whether or not we should do Adobe versus Progressive. I guess we take a look at Adobe. I think right now there's a lot of negative sentiment surrounding this company, like, oh my gosh, AI is going to make them obsolete. Their products are useless, but that's just not the case because they just posted their earnings. And I want to talk about that first. Look at it on a quarterly basis. For a company where AI is making them irrelevant, you tell me, the past 90 days, leading up to August 29th, how in the world did they increase their revenue by 10.7%? Take a look at this. How the heck are they increasing their revenue every single year without fail if AI is truly ruining their business model? When I think about Adobe, it reminds me exactly of Google. Everybody just echoes the exact same sentiment. It's an echo chamber. Oh, Google is done. They're cooked. Really? Look at Google now. Their search line of business is thriving. It's growing. This is the exact same way I think about Adobe. But I'm sorry, I think my bias is coming out. Let's just look at the numbers to see what exactly we are working with. So Adobe, they own a SaaS ecosystem where you can do video editing, photo editing, and the list goes on and on. They also have the proprietary tech for PDF files and everything. In my eyes, it's a company that's very similar to Microsoft. Their software and their features are pretty much used by every single S&P 500 big company. And if we take a look at what we're working with, right now, their forward trading multiple is a 15.4. Are you freaking kidding me? For a tech company that's posting numbers this juicy, I'm almost offended. Hopefully you understand where I'm coming from. If we scroll down and take a look at their bottom line per share, this is a company that is very asset light. They're not manufacturing toys or making chips. They're selling virtual digital software. They're not running warehouses. They're not running factories to manufacture anything. So I am going to assume, without even looking at it, I promise, my eyes are small, but I promise I'm not looking at it. I guarantee you that their earnings per share is pretty darn good. So if we take a look at, oh my gosh, $16.05 of profits per share. Are you freaking kidding me? Oh, by the way, I think this is a perfect time for me to plug that the website that I'm using right now is stockanalysis.com. In the past, I used to use like 7 or 8 different websites that were free in order to do the exact same thing that I'm doing with stock analysis. Like Yahoo Finance, macro trends, the list goes on and on. So instead of having like 10 tabs open, now I only need to have 1 tab open, that's stock analysis. So if you want to sign up using my referral link that's down below in the description, you'll get 10% on top of whatever promo they have going on. Just a shout out to Stock Analysis because they have made the research portion of looking at stocks a little more efficient in my opinion. So right off the bat, we can go ahead and make the assumption that through their numbers, Adobe is just crushing it. Their gross sales are increasing by double-digit rate, 10.6% year over year. If we look at it on a quarterly basis, 10.7% year over year. And their bottom line per share growth is 35.8%. Are you freaking kidding me right now? But let's go ahead and see, are they cooking the books? Is their balance sheet good? So their cash and cash equivalents is $5.9 billion. It seems to be stabilized for the past 10 years. Well, it did increase. It went from 3.9 billion to 5.9, but it is worth mentioning that it did decrease by 20% year over year. And that's because they tried to do a merger with Figma, but the court said no, because y'all are going to be way too big and it's going to be a monopolistic practice in order for that to happen. So they had to pay a penalty fee. I think it was like $1 billion. So it kind of makes sense of why their cash disappeared. I'm assuming it was because of that court case. And if we take a look at their total debt, it's $6.6 billion. So after paying off their total debt on the books, which includes everything that's in the short-term obligation field plus 20, 30 years out, they still have $696 million of loans on the books. But that doesn't paint the full picture. Let's jump on over to look at their debt-to-EBITDA ratio. It's a 0.72. So in a matter of like 8, maybe 9 months, they can pay off all the loans on the books. So I would argue this is a cash-heavy company. And let's look at their free cash flow per share to verify that, because the free cash flow is how much cash is left over from your operations. Whereas the earnings per share on the income statement tells us the accounting profits per share, this one shows us the true value of cash on the books per share. Their free cash flow per share is Dude, this is just bonkers. $22.16. My goodness gracious, year over year, that increased by, 46.5%. I'm going to be honest with you. After this video, I am going to watch Tottenham play against Villarreal, but I'm also going to be investigating Adobe a little further because I'm seeing an undervalued compounder. I think the markets have it wrong with this one. All right, so while holding hands, we looked at a pharmaceutical company, AbbVie, market cap $382 billion, and we also looked at Adobe, $149 billion market cap, a SaaS company. Which one should we look at next? I think we should look at the Progressive Corporation, which is an insurance conglomerate that Joel Greenblatt would not like because it's categorized into the financial sector. I think the insurance industry, I made a dedicated video talking about why Warren Buffett loves insurance stocks. You should go ahead and watch that one to see why I see eye to eye with Warren Buffett. Let's take a look at the Progressive Corporation. They basically do car insurance, home insurance, everything insurance related except, I think, health insurance. I don't think they operate in that space. But anyways, what are we working with? So a 13.8 current PE ratio. Their forward trading multiple is a 14.8. If we do year to date, only 2.2%. It looks like as of, June, they reached the high of about 288, and they've just been selling off since then. So if we do the past 1 month, they're down by 0.8%, past 5 days, 0.7%. So they're basically trading flat. I think they've reached their low. I mean, I would have to look at the technical analysis to look at their lower Bollinger Band and their 200-day moving average to confirm that. But on a surface level, I think one could argue they pretty much have hit their bottom. Let's take a look at their financials. So here's what I just want to show you what I'm looking at. 2018, their revenue was $31.9 billion. And now it's $82.3 billion. So effectively in 7 years, they more than doubled their freaking revenue. Dude, that is absolutely diabolical. 2015 is $20.8 billion, and now it's $82.3 billion. Okay, I'm going to say this right now. I think Joel Greenblatt, he might be onto something with the magic formula, but let's give us some credit to you and me. We added the modification filters to improve his magic formula. And I think we're finding some compounders that do seem to be undervalued. Whether or not you like the industry or space like me, I don't really like the pharmaceutical space, but I can't deny that AbbVie is undervalued. I don't like them. I would never invest into them. But based on what we are seeing, this is not a bad stock screening filter. So $82.3 billion, it's a growth of 21.5%. Dude, that I'm almost triggered. How the heck are they growing their business, the top line, by 21? Let's take a look at their earnings per share to see the efficiency of their business. 17. Are you kidding me? Look at these numbers. It increased by 52% year over year. Okay, so not only am I going to be looking at Adobe after this video, I'm also going to be taking a closer look at the Progressive Corporation, which was featured in the insurance industry breakdown video that I just alluded to like 3 or 4 minutes ago. You should watch that video and see why I still think very highly of this company. They're still printing cash. Take a look at their cash flow. Free cash flow should be really high because they're asset light. They're not manufacturing a car, right? Those CapEx factories and production lines, it takes a lot of cash flow in order to make cash. But for an insurance company, especially with the integration and implementation of AI, I feel like their free cash flow is only going to improve going forward. But anyways, what are we working with? $28.02 of free cash flow per share? 25% increase year over year? Dude. Are you kidding me? 27% dividend payout ratio according to the accounting GAAP methodology of earnings per share. But still, even if we apply that free cash flow of 20 something bucks to the $4.90 of dividends per share, it would still be around the same number. Absolutely sustainable. The growth rate, that's almost funny money. I think, based on my memory, I think Progressive is a company that pays a special dividend every 3 or 4 quarters. I could be wrong because I made that insurance industry breakdown video like a month or 2 ago. But let's investigate and see what's going on. So instead of growing their dividend in a traditional format, they just pay you a really high one every 3 to 4 quarters, as you can see on your screen right now. So it seems like they pay a 10-cent dividend every 90 days, and then they hit you with a bam, $4.60. They hit you with a bam, $1.50, and they hit you with a $4.60 dividend. Bam, they don't have to do this. They're not a REIT. They're not a BDC. They're not legally required. They pay out so much of their earnings out as dividends. But this is a company that prints so much freaking cash, they just go ahead and give it back to you in the form of a ridiculous special dividend. So I have homework. I'm definitely going to be investigating the Progressive Corporation because I think I'm going to put in some buy orders to pick some up. Yes, I think there is the theory that as the interest rate falls, so will the profitability and the growth of insurance companies. I feel like the Progressive Corporation is so big, it's a behemoth, that even if the rates do get cut, I feel like they should still be running in a very efficient operation to the point where their fall and demise is a little exaggerated. And I would love to buy into them if in fact they are undervalued right now. I know I'm a weird character and I'm kind of out there, but are you starting to see how I process, filter, and interpret data on the market to figure out, is this company good or not? Hopefully you're learning a thing or two. If you are, my big pinky toe and my face and my heart would appreciate it if you click or tap that like button. But anyways, what else are we working with? We have McKesson, hospital equipment manufacturer, Dell. Dell is a company that I just don't like because I feel like they do not have an economic moat. But whenever I revisit and look at them, they're always crushing it for one reason or another. Because they have so many competitors that do exactly what they're doing. Lenovo, HP, you've got Apple MacBooks, but somehow Dell is always thriving. But I'm going to skip them. I don't want to look at them. I want to look for one that, Booz Allen Hamilton, a government contracting, consulting, and staff augmentation company. They're basically in the business of putting their team of 3 or 4 consultants into an office of a 3-letter agency like the Department of Transportation, Department of Veteran Affairs, whatever, and then helping them integrate technology into their servers or to improve their websites, and etc. And I'm going to tell you right now, I just did a deep dive on the Booz Allen Hamilton company about 4 days ago, over the weekend, and they're massively undervalued. And I'll show you. Year to date, they're getting hammered, negative 20.8%. And that's because objectively, the amount of contracts that they have been awarded to work on government-related stuff have been slashed, cut, or even frozen altogether. These guys, I've been looking at the consulting forums, they've been doing layoffs here or there throughout this whole year. Now, with a consulting agency and a firm, the amount of consultants that you have on staff, not considering the ones that are sitting on the bench, is in correlation to how much revenue they can generate, billable hours to their clients. If they're reducing their headcount, that means the amount of money they can make is also shrinking. But they're also making that pivot into becoming a tech software consulting firm instead of just doing the traditional modality of staff augmentation. So I believe in their pivot, and I still think they're high quality. So even though they're on this dip right now, some people might say or argue that it's a falling knife. Dare I even say, I think it might be a buying opportunity. That's not financial advice. It's just me talking to myself because I'm crazy. I'm like, oh, this thing looks good. I'm crazy, all right? So their current trading multiple is a 12.5. They're basically being priced by the markets. Whenever you see a trading multiple that's like a 7, 8, 9, 10, or even like 11 or a 12, they're basically pricing in that you ain't gonna grow. You're shrinking. There's no expectations baked in for you. They basically don't like you. They're like, dude, see you later. But having said all of that, let's jump on over and take a look at their financials. You tell me, does this look like a terrible company? Consistently and reliably growing their gross sales year over year. And if we scroll on down to take a look at their profits per share, what are we working with? $8.15. So even though Booz Allen is losing contracts, which equals into potential revenue in their backlog, somehow they're increasing their margins and improving their bottom line, $8.15. I would argue that's pretty amazing. That's pretty cool. And I think to look between the lines, I think we need to zoom in. Because right now we're looking at it on a 12-month basis. year over year, as you can see, fiscal year 2025, 2024. I want to look at it on a quarterly basis so that we can look at the past 12 weeks in conjunction with the past 12 weeks before him. And there you can see a more transparent and objective depiction of what's going on. So the 90 days leading up to June 30th, it looks like their revenue was flat, $2.9 billion, and the Q4 2025 was $2.9 billion. So yeah, they're not increasing their revenue. So that's a yellow flag in my opinion. But what about the earnings per share? Their earnings per share improved 70.4% in the past 90 days year over year. Q1 of 2026 compared to Q1 of 2025 was $1.27. So they're improving their operations and profitability, but they're not growing their business because they're losing their contracts. Take a look at their balance sheet, $711 million. I mean, it's not the worst thing in the world, but at least it's improving from their lows of about $223 million in 2023. And if we scroll down, take a look at their total debt, $4.1 billion. So their net cash to debt is negative $3.4 billion. I want to take a look at their dividend profile. They're growing their dividend at a rate of 8% because their earnings per share is just aggressively going to the moon. 2.1% dividend yield, absolutely sustainable and it's healthy. I like what I see with Booz Allen Hamilton. I'm not trying to tell anyone what to do with their hard-earned money. I'm not invested into this company, but I've been telling the folks on Patreon, I've been eyeballing them, and I'm trying to buy into them at a very specific price. If it never happens, so be it. I'll go to sleep and I'll still wake up happy. But if I do buy into them, I would be happy as well. Either direction. Now, I think up until this point, we've been seeing the really good compounders that do seem to be undervalued for the most part. But let me see if we can talk about and analyze and dissect a company that is not so cute, not so pretty, not so handsome young man. You know, that's what I call my dog. His name is Bernie. And I always, whenever I pet him, I go, "You are a handsome young man." I don't know why I do that, okay? I'm in my mid-30s, but I always make my voice sound like Mickey Mouse from like the 1950s whenever I talk to my dogs, but he loves it. Because when I talk to him like that, his ears pin back and his eyes become like lovey-dovey. I don't know. Let's find a potential value trap by doing it like this. And instead of taking a look at the companies that do not have a future EPS guidance, let's look at one that has like an absolutely ridiculous single-digit PE. I'm really surprised that Western Union is not here, but Yelp, Merck. What about Bath and Body Works? It's the place that my wife loves to step into every time we visit a mall in the US. They basically have fragrances for anything on planet Earth. Green tea, cherry, watermelon. And I will say this, even though their soap is super overpriced, it does smell freaking good. Anyways, what are we cooking with? Trading multiple is a 7.6, forward PE is a 7.2, and we just learned what does that convey? That the markets expect nothing from them. They're basically just rolling over and taking their last breath on the battlefield. And year to date, negative 32.8%. Past 1 year, negative 4.3. If you invested into them, for instance, September of 2020, you would be down 10.2%. And I don't know about you, but that's not exactly comforting to see as a potential investment, right? Jump on over to their financials. Ooh-wee, this is disgusting, dude. Up until 2019, it was $13.2 billion, and then it just fell off a cliff, $5.4 billion. It's just been relatively flat. As you can see, since 2022, it's just been around that $7 billion mark. And actually, since 2023, it's been declining every single year. And I think that's because, man, I looked into this company and I think they did a spinoff of one line of their business to make it more efficient and agile. So I think that explains the drop off in the revenue. But the point still stands that despite operating as just Bath and Body Works, to be flat in your revenue for the past like 3 years, it doesn't really exactly give me that fuzzy feeling in my stomach like eating Taco Bell at 11 p.m. at night and regretting my decision by 11:05 when I'm on the toilet. Not exactly a good, what did I just say? But anyways, earnings per share. All right, well that improves the situation a little bit. It's stabilized. Like it's not volatile, like growing, decreasing. It seems to be in about $3 and X amount of cents since 2023. I mean, obviously it declined from its high of $4.89 in 2022, but I guess what can you say when you're trying to sell hand soap for like $75 per unit? I just feel like that's a ripoff, but it does smell nice. And if we jump on over to their balance sheet, oh dear, this is really bad. They're quickly running out of cash. $2.5 billion and now they're $364 million. Sounds like a lot when you say it out loud, $364 million, but when you look at it in a bigger picture view, they're losing their cash and at a fast and an aggressive pace. I bet you they're highly leveraged. Okay, do you want to make a bet? I bet they're highly leveraged. Okay, ready? Scroll down, take a look at it. Total debt is $4.9 billion, and it's pretty much flat. I guess they like to operate with around $5 billion of debt on the books. Doesn't exactly give me a fuzzy feeling, guys. Maybe, is this sustainable? Oh, their debt does seem to be sustainable. A 2.5 EBITDA ratio, not bad. But I guess on surface level, I don't really like that their cash is evaporating, like my hairline. It's just going back and back. Dude, I noticed that. Like, on the corners of my temples right here, my hairline has just been eroding. And that's exactly what's happening to the cash and cash equivalents. Are they a dividend payer? They are a dividend payer, 3% dividend yield. But, whoa, why does it say not available? Let's see what's happening. Let's look at their dividends visually depicted. Ew, they cut their dividend once in 2019, and they cut their dividend during the pandemic. That's why there's a huge gap, 2020 to 2021. They increased it to 20 cents, and it's been flat since 2022. So this might not be well received. However, I'm just going to come out of the closet and just say it. This company, they might be down 32.8%. And because of that, one might make the assumption that they're undervalued. But for me, it's kind of like buying expired milk for 33% off. Because at the end of the day, it's still spoiled milk. They are 7.6 PE ratio for a good reason. It's not because they're cheap or undervalued. They're being priced accordingly by the market, by other investors, by the hedge funds. We do not see the future sustainability of this company laying down a solid and a firm foundation. This company, I'll reserve my tongue. Just in case you're invested into them, for me, not my cup of tea. There's nothing about them that makes my spidey senses go off saying, dude, this looks like a compounder. When I look at Bath & Body Works, I see a value trap. And as a matter of fact, I kind of want to put that to the test. So now I'm on a website called financecharts.com. This is free, and we're going to put in BBWI, Bath & Body Works. And basically, I'm taking a look at their adjusted stock price total return. When you take into account their share price appreciation plus the dividends paid out being reinvested into said stock, what is their total return? Past 1 year, negative 7.6%. Past 5 years, 18%. So you would be in the green 18% by holding on to them for the past 5 years, even though earlier we learned that the share price went down by 10% because of the dividends paid out. You're still ultimately in the green. And if we do 10 years, we're working with negative 48%, 15 years, 197%. And that's because they were trading for about $9 back in September 2010. They're currently 26. If we do 20 years, a 441%. So it seems like their growth story reached the high at the end of 2021. And since then, it's just been eroding and declining. So for me, I'm just not very enthusiastic or confident in BBWI. Before this video turns out to be like 50 hours long, I just want to ask you this question as we review the remaining 51 stocks. What do you think? After taking a look at the magic formula with our modified filters applied, are any of these companies in your portfolio? Are any of them worth investigating? Like, should I make a dedicated deep dive video for one of the ones we talked about, one of the ones we didn't talk about? There's 51 companies in total. I'm scrolling here so you could take a look at and see the full list, just in case you're curious. And before I head out of here, I just wanted to plead my case of the argument for dividend growth investing. What you are seeing on your screen right now is my portfolio's performance against the other major indexes for the past 1 year. And as you can see, my portfolio yielded 25.5%. The S&P 500 is 19.2%, and I think the QQQ, which is the NASDAQ 100, which is like the Mag 7, NVIDIA, all the big tech stocks, I think it was like 22%. So dividend growth investing came out on top. It's pound for pound the best fighter in the world. And the reason why I'm sharing this with you is not because I want to boast or brag, but it's because I get comments from time to time from people saying, oh, you're too young to be doing dividend investing. Or people saying, why would you dividend invest? Are you happy with getting like a 3 or 4% ROI? Whereas the facts speak for themselves, that dividend growth investing in the long run beats out every other form of investing, especially speculative day trading. Because at that point, you're walking into a casino and just pulling the lever on the slot machine. You're gambling. But with dividend growth investing into high quality dividend compounders and then buying into them while they're on the dip, the data works in my favor. Time and time again, you come out on top. Well, you should watch that video because I looked at the research and I was like, well, geez Louise, no wonder I've been doing that. So my formula for success is pretty darn simple, right? I focus on dividend investing by buying only high quality dividend compounders while they're beaten down. I don't like to overpay for a dividend compounder that has a trading multiple of like 100. I wait patiently. I put them on my watch list, and if they go on a dip, sell off, or a correction, then I dollar cost average. I never ever like to buy ugly, hairy, smelly companies because they're cheap. Because I think that's one of the fastest ways to just lose money, unfortunately, because you're hoping for a magical turnaround or rebound story, whereas the numbers and the data, it's not going in their favor. So it's almost like the same thing as pulling that slot machine lever. You're gambling at that point. And if you're curious about my portfolio and the holdings within it, the breakdown is currently only available on Patreon, but I do plan on starting a weekly series where I share with you my updates, transactions, dividends pouring in, and ones where I'm thinking about selling or buying. But I haven't started that series because I'm currently on the table and working with different mobile apps and platforms to figure out who I should pick to sponsor the channel. So once the negotiations are hammered out, I'll roll out that series. Anyways, if you made it to the end of the video, I love you guys. Stay safe. Good luck in the stock market. I genuinely hope that you learned a thing or two from this video. Hopefully you gained value from it. With that said, peace.